investor friends, I'm Michelle Marki, and as it's getting to be fall, we're starting to see a lot of familiar patterns like leaves falling from trees and people getting their pumpkin spice lattes on. And one pattern we haven't seen in 4 years is the stock market tumbling in anticipation that the Federal Reserve will have to hike interest rates more aggressively than the stock market wants it to. And that's why as interest rates generally go up, that means stock prices generally go down. And so we're seeing the stock market not being very happy about the Fed likely having to raise rates by 75 basis points, as that's pretty much a done deal at the time I'm recording this. And so we're seeing the stock market go down and articles fear-mongering about it. And so as investors, we're going to want to separate noise from signal. And I found an article that makes a really good example of this, where I'll show my reactions to why I think they're wrong instead of leading you to having fear and making maybe bad investing decisions as a result of that. You can wisen up to this and make better investing decisions, like buying your favorite company stocks on sale instead of being fearful and selling your stocks in a panic. So if that sounds good to you, I hope you'll like and subscribe to my video and YouTube channel. And let me point out where you should do the opposite of what this article is likely maybe making you want to do. And the article's headline does more to spread fear, uncertainty, and doubt than really be of much use, where it goes like this: the next rate hike will spark dangerous game with the state of the economy, investor Peter Bookvar warns. And even though I haven't heard of this person before, apparently he's the chief investment officer of the Bleakley Financial Group. And maybe that's fitting because this Bookvar person is so bleak about the future of the economy and the markets. And maybe it's better as entertainment value rather than serving as real investing guidance. And so let's take a step back and explain what's going on here a little bit. The Federal Reserve is dealing with some of the highest inflation we've seen in 40 years, where consumer price index inflation came in at a high of 9.1% recently in June 2022. And even though it's come down a little bit from there, like it went down to 8.5% in July and 8.3% as of August lately, that means that we're still dealing with much higher inflation than the average 2 to 3%. And as a frame of perspective, back in September 2018, it was at 2.3%. So inflation is a whopping 6% higher than back then. And the stock market was already freaking out when the Fed funds rate was only at 2 to 2.25% back in September 2018. And it went up as high as between 2.25% to 2.5% in December 2018, the same Fed funds rate that it is currently. And so it's no wonder that the stock market is reacting fairly negatively to a higher interest rate than maybe it's accustomed to, because we've been having some historically low Fed funds rates, and that's been dictating low interest rates everywhere else, like with mortgage rates and other loan rates. And so a lot of people have been fairly lucky in being able to borrow cheap money at pretty low interest rates, but all of that is about to change, like how we're seeing mortgage rates top 6%, and we haven't seen mortgage rates that high in a really long time. And so the good days of cheap debt are kind of over now. And so that's why a lot of markets and articles are talking about how bad this is, because usually we want to be borrowing money because in America, one person's debt is another person's income. So maybe this is how normally the debt cycle goes around. But the fact that the party is ending with the Fed having to hike rates to combat raging inflation is putting a damper on the stock market. So based on all this, the Fed is likely having to hike rates to the new range of 3 to 3.25%. And that's happening as of the September 2022 Fed meeting. And so from there, who knows where the Fed will have to raise rates next, but that's what we're dealing with now. And I think that Mr. Bookvar is just adding to the noise by saying things like we're getting into treacherous waters with this September's rate hike going to be only the second time in 40 years that the Fed funds rate is going to exceed the prior peak in a rate hiking cycle. And while that may be true, like Last time that this kind of thing was going on, it was in spring of 2019, where the Fed funds rate was at a high of 2.42% before the Fed seemed to give in to the stock market crumbling, and then they lowered rates thereafter by the summer of 2019. And right now we're seeing the Fed funds effective rate get pretty close. Like as of August, it was at 2.33%. And when the Fed hikes it to about 3% to 3.25%, very soon after that, we should start seeing rates way exceed what it was in 2019. And that's probably going to throw the markets into a hissy fit again. But where this person is saying that this is getting into treacherous waters, I'm saying that this is opportunity for us, because if we have identified some of our favorite company stocks, then we're able to buy them at discounts to what we believe they could be worth. And so instead of seeing this for just the noise that it is, we should look past it and see it as a signal that it could be a very good stock buying opportunity for us. And while Fed Chair Jerome Powell has said that they're going to stick with hiking rates to hopefully bring down high inflation, in my humble opinion, I think that higher than expected inflation is here to stay for a while, because we've seen the Fed's balance sheet being twice what it was back in 2018 at almost $9 trillion. And it hasn't really budged and come down all that much yet. And this is in addition to the government still spending a lot of money and doing things like student loan forgiveness, which, while important, is still adding fuel to the inflation fire. So for those reasons, I think that inflation is not coming down fast enough. And so that's why this bookvar person is warning about things like how investors are going to be dealing with the economic consequences of wealth destruction and earnings declines, where he said that if labor costs remain sticky, if they continue to rise at the same time the revenue side starts to slow in the face of this slowing economy, you're going to have further cuts in earnings estimates at the same time. He doesn't think that this market just ends with a PE multiple at 17, but he believes that the markets will have a PE multiple go down to as low as 15 times. So what I think this means, instead of being a bad thing, we should look at this as a good thing, unlike what he thinks is wealth destruction, where, like I tell my friends and family, you haven't lost money in the stock market until you've actually locked in the sale of the stock. So I wouldn't look at your portfolio going down in percentage as if you've lost money. So I think he's wrong in saying that this is wealth destruction. It's only a loss if you lock it in. And also earnings declines, I think that's a real thing, because more and more analysts are starting to lower estimates for what companies will produce in the coming quarter. So even though that may be true, we should look at this as a buying opportunity, where maybe companies will not be able to produce as high of revenues or free cash flows as they did during the times of cheap debt, but we should reassess what is a realistic valuation for these companies nowadays, and maybe we can buy them at maybe 50% of a discount compared to what we believe they're worth. So I would focus on the company's fundamentals and what you think is a realistic performance rate in terms of their revenue growth rates or free cash flow growth rates for the foreseeable future in higher interest rate environment. And this article might influence you to believe that the Fed's current aggressive rate hike schedule is a bad thing, because they said things like, we went from a place where we could not raise rates even in good times, let alone difficult times, because stocks, the economy, and housing might not be able to handle it. But what they fail to mention is we're dealing with some of the highest inflation that we haven't had to deal with back when inflation was only at 2 to 3% on average. That's why maybe the markets were so sensitive 4 years ago when the Fed dared to raise rates above 2%. And now that the Fed is raising rates above 3%, even though most likely markets are going to fall even more as a result of the Fed having to hike rates even beyond 3%, like probably 4% or more. And most likely that's going to mean that stocks are going to go down even more in the coming months, and likely throughout 2023 and maybe into 2024. So this is sort of short-sighted if you just look at this as kind of noise and not really pay too much attention to it, even though they say some things that could be true. Like when it comes to housing, they wrote that we're just barely seeing the cracks in housing. So as that starts to come down, people are going to feel like they had less money than they did before. And then we don't know what that's going to do to the economy. This 75 basis point rate hike might even be a mistake. we know there's a lag. And what they mean by lag is that it takes some time for the real economy to feel the effects of when the Fed raises rates. So we're starting to see some of the effects play out now when mortgage rates are 6% and above. And what that has meant is that mortgage monthly payments have skyrocketed. Like, it used to be that mortgage monthly payments were within a couple of $100s of what the median rent was throughout 2021. And that's jumped by almost $600, where the median rent nowadays is about $1,300 per month compared to the average monthly mortgage payment of being around $1,900 per month, according to the Wall Street Journal. So that has meant that maybe people couldn't afford as much house as they did when mortgage rates were much lower, like between 2.75 to 3%. And so with mortgage payments being way higher, maybe that means more people are going to have to save their money and rent for now and wait for home prices to come down into a range that makes the mortgage payments more affordable. And what people could do in the meantime is invest that difference that they're not paying on a mortgage payment and invest it in stocks, or maybe even a Series I savings bond that's still giving a 9.62% interest rate. So those are some alternatives when maybe you might not be investing that money in real estate. And also, I would look on the bright side of, in spite of all what looks like kind of negative effects, in that maybe this is giving you a buying opportunity of a lifetime, where this could lead to generational wealth down the line, where it could look like your portfolio is in red, but you have to ignore that noise and just focus on the signal that this could be an amazing buying opportunity, where as the stock market keeps going down, you keep buying instead of what most people are probably going to do, which is sell, because you're buying a stock from someone who thinks that they have to sell the stock. And maybe this will pay off for you, where if you believe that this stock will recover in the future, you're more likely to do well if you have conviction rather than being influenced to believe that you shouldn't stay in stock. So just keep all that in mind. And if you found this video helpful, please like and subscribe. And I wish you well on figuring out what is signal compared to noise, and hopefully making the best investing decisions that's right for your future. Till next time.